Welcome to The Explainer. Today, we're diving straight into a forgotten 1970s stock market bubble that completely wiped out some of the most dominant corporate giants on the planet. And what makes this so incredibly fascinating, and honestly maybe a little bit terrifying, is that it looks disturbingly similar to the stock market we're looking at right now. We're going to unpack the data, the history, and the psychology to figure out exactly what happened back then and, more importantly, what it means for us today.
Okay, let's kick things off with a piece of wisdom from the legendary investor Sir John Templeton. Now, this is a guy who averaged 15% annual growth for 38 years, so he knows a thing or two. He famously called "this time it's different" the four most expensive words in the English language. And he was absolutely spot on, because if history shows us anything, it's that nothing empties a brokerage account faster than blind optimism dressed up as financial genius. Wall Street just loves doing mental gymnastics to justify soaring prices. To see how this actually plays out, we've got to look backward.
Section 1. The Rise of the Nifty 50.
To really understand today, we need to travel back to the late 1960s. The U.S. was riding this massive post-World War II economic sugar high. Factories were booming, suburbs were popping up practically overnight, and Americans felt entirely invincible. I mean, we just put a man on the moon and invented the Etch-a-Sketch. Life was good, and confidence was absolutely off the charts. And that relentless optimism, it translated into sheer scale in the market. From the end of World War II in 1945 all the way to 1970, the U.S. stock market skyrocketed by over 350%. It was this unprecedented 25-year bull run that made investors feel like losing money was just mathematically impossible. So this massive, continuous growth birthed a brand new, seemingly no-brainer investment strategy. They called them one-decision stocks. The concept was incredibly simple. You invest in companies that are so powerful, so dominant, and so stable that you only ever have one decision to make, and that's to buy. You would never, ever sell them. We're not talking about sketchy penny stocks here. These were household blue-chip names. Coca-Cola, American Express, McDonald's. They became known collectively as the Nifty 50, and investors viewed them as completely 100% bulletproof.
But here's the funny thing about investing. If something sounds like a guaranteed win with zero downside, it is almost always a financial grenade with the pin already pulled. Check out these valuations. The average price to earnings, or PE ratio, for the overall market in 1972 was sitting at a humble, totally normal 15. But because of that intense never-sell mentality, the Nifty 50 stocks were priced as if gravity just didn't apply to Wall Street anymore. Look at McDonald's trading at 86 times earnings. Polaroid was at 90. Overall, the Nifty 50 averaged a jaw-dropping PE of 42. Honestly, these were fairy tale valuations.
And that never-sell mindset, it built into a massive, teetering structural problem. At the peak, just the top 5 Nifty 50 stocks alone made up 25% of the entire market. Collectively, these 50 companies accounted for roughly 45% of the total U.S. stock market. Just think about that for a second. Nearly half of the market's entire weight was riding on the blind assumption that these specific companies would grow fast enough to justify their ridiculous price tags forever.
Which brings us to Section 2, the 1973 reality check.
Because as it always happens when markets detach from reality, the music eventually stops. Enter 1973 to 1974. And it wasn't just one thing that went wrong. It was a devastating cascade of macroeconomic dominoes. Oil prices suddenly quadrupled. Inflation surged from a calm 3% to over 11%. Unemployment doubled overnight, jumping from 4.5% to 9%. On top of all that, President Nixon effectively ended the gold standard for good. The economic foundation completely cracked.
The fallout was catastrophic. Between 1973 and 1974, the overall stock market plunged by 50%. It was officially the absolute worst bear market since the Great Depression. So the absolutely crucial takeaway here is this. When the macroeconomy falls apart, wildly overpriced stocks don't just experience a polite little correction, they get obliterated. The so-called bulletproof Nifty 50 companies essentially became a financial obituary. Coca-Cola shares crashed over 60%. McDonald's plummeted over 70%. And Polaroid, it collapsed by more than 90%. Those one-decision stocks proved pretty quickly that the decision to never sell was a truly disastrous one.
And here is the real gut punch. The pain lingered. This wasn't some quick, cute V-shaped bounce back like we saw after the recent pandemic crash. Investors who bought into the dream of eternal growth found themselves trapped in financial purgatory. It took the market 8 grueling years, all the way until 1981, just to crawl back to the exact same break-even level it had been at before the bubble popped.
All right, Section 3,
The modern echo, the Magnificent Seven.
Now, if hearing this story gives you a creeping sense of déjà vu as you look at your own portfolio right now, you are certainly not alone. Mark Twain is often credited with saying, "History does not repeat itself, but it does rhyme." And when we look at the stock market today, man, it is undeniably rhyming with the market of 1972. It's like we're watching a movie with the exact same plot. It just features much shinier special effects.
Let's compare this modern concentration to what we just saw in 1972. Today we have the Magnificent Seven. That's Apple, Microsoft, Google, Amazon, Meta, Tesla, and Nvidia. Right now, these 7 tech behemoths make up roughly 36% of the entire S&P 500 index. Just 7 companies are carrying the weight of the entire U.S. stock market. That is an eerily familiar level of top-heavy concentration, wouldn't you say?
Now, I know what you're probably thinking, but today's companies are literally changing the world. They are incredibly innovative, and they completely dominate their industries. And hey, that is absolutely true. But here's the thing. So did Xerox, Polaroid, and Avon back in 1972. The Magnificent Seven are the modern echo of the Nifty 50. They are the new one-decision stocks. Investors today are acting as if buying these giants is a completely risk-free, bulletproof bet.
And that brings us right back to the math, valuations. Are these modern tech giants priced fairly? Well, let's just say they're also priced like gravity doesn't affect them. Google and Meta trade around 28 times earnings. Amazon's at 35. Apple at 37. Microsoft at 38. Nvidia at 50. And Tesla, an astronomical 247 times earnings. Are they solid, world-class companies? Absolutely no doubt. But are they also overpriced, overweighted, and worshipped as if they're completely invincible? Also yes. Investors are telling themselves the exact same bedtime story they told in 1972, that these companies are untouchable and will simply grow forever.
Which leads us to Section 4. Will history rhyme again?
So are we really just waiting for a couple of macroeconomic dominoes to fall, sending us right back into the purgatory of the 1970s? Warren Buffett summed it up perfectly when he noted that what we learn from history is that people simply don't learn from history. We are constantly drawn to speculative manias, and we always manage to convince ourselves that the old rules of valuation suddenly no longer apply to our shiny new investments.
So, I'm going to leave you with this final thought to chew on. Look at the immense concentration today. Look at those sky-high PE ratios, and look at the blind optimism everywhere you turn. Are we currently staring at a dangerously top-heavy market, pretending that valuations just don't matter, and collectively whispering those 4 wildly expensive words, "This time it's different"? Thank you so much for joining me for this explainer. Keep asking the hard questions, keep looking at the data, and we'll see you next time.